On February 3, 1637, an auctioneer in Harlem stood before a room full of traders holding tulip bulbs worth more than houses. He started the bidding. No one raised a hand. He lowered the price. Still nothing. He dropped it again. Silence. In that moment, the most spectacular financial bubble in history didn't pop. It evaporated. Within days, tulip bulbs trading at 5,000 guilders, the price of a luxury canal house in Amsterdam, were worth 50 guilders. Then 5. Then nothing. Fortunes built on flower contracts vanished overnight. And the Dutch Republic, at the height of its golden age, learned a lesson it would never forget. This is where money, power, and history collide. And nothing is ever as simple as it looks. For decades, historians dismissed Tulip Mania as a ridiculous footnote, a cautionary tale about irrational crowds paying absurd prices for flowers. But the truth is darker and more relevant, because Tulip Mania wasn't just about tulips. It was the first modern financial bubble, the first futures market, the first time ordinary people used leverage to speculate on assets they'd never seen and couldn't deliver. And when it collapsed, it didn't just destroy individual fortunes. It shattered trust, broke contracts, and revealed that financial markets, no matter how sophisticated, are built on nothing but belief. To understand why tulips became the world's first speculative mania, you need to go back to the 1570s. Tulips arrived in Holland from the Ottoman Empire, brought by botanist Carolus Clusius. He planted them in a research garden in Leiden, studying their medicinal properties. But his neighbors had other ideas. They broke into his garden, stole the bulbs, and started selling them. This wasn't theft for survival. It was theft for profit, because tulips were exotic, rare. And the Dutch, newly independent from Spain and flush with wealth from global trade, wanted rare things. By the early 1600s, tulips became status symbols. The Dutch Golden Age had created a new merchant class: wealthy traders, successful artisans, people with money but no aristocratic lineage. Tulips gave them a way to display wealth. A single bulb of the right variety, planted in a garden visible from the street, announced that you'd made it. You were part of the elite. And the rarest tulips, the ones infected with a mosaic virus that created flame-like streaks of color, became the most coveted. Semper Augustus, Viceroy, Switzers, names that meant nothing 5 years earlier suddenly carried the weight of fortunes. In 1623, a single Semper Augustus bulb was valued at 1,000 guilders. By 1625, 2,000 guilders. By 1637, 5,500 guilders. That's the price of a grand house on Amsterdam's Harengracht Canal, complete with a coach house and an 80-foot garden. For one tulip bulb, a skilled craftsman at the time earned 350 guilders per year. A Viceroy bulb sold in February 1637 for 6,700 guilders. Nearly 20 years of wages for a single flower. But here's where the story stops being about flowers and starts being about finance. Tulips bloom for 1 week in April or May. During their dormant period from June to September, they can be dug up and transported. That's when actual physical trades happened. Bulb in hand, cash exchanged. But demand was year-round. So traders invented something new: futures contracts, promissory notes that guaranteed delivery of a tulip bulb at a future date. The buyer didn't need cash today. The seller didn't need the bulb today. They just signed a contract. And that contract could be traded, bought, sold, resold. This was revolutionary and disastrous, because futures contracts allowed people with no interest in tulips to speculate. A weaver in Harlem could buy a contract for a Switzer bulb he'd never plant. He'd sell the contract to a baker who'd flip it to a merchant who'd pass it to a sailor. The tulip changed hands 10 times before anyone even saw it. And each transaction drove the price higher. By January 1637, common Switzers, bulbs worth almost nothing 6 months earlier, were trading at 20 times their original price. Some contracts increased 20-fold in a single month. At the peak, traders were earning 60,000 florins per month. That's the equivalent of over $61,000 in modern currency. From flowers, People mortgaged their homes to buy tulip contracts. Weavers sold their looms. Farmers traded livestock. An entire economy built on credit, leverage, and the belief that prices would keep rising forever. Because why wouldn't they? The wealthy would always want tulips. Demand was infinite. Supply was limited. The logic was bulletproof. Until it wasn't. Late January 1637. Isolated florists started selling. A few contracts didn't find buyers. Word spread. By February 3rd, panic hit. The Harlem auction failed. No bids. Not at asking price. Not at half price. Not at any price. The market for tulip bulbs ceased to exist. Bulbs that had traded for thousands of guilders the week before sold for 1 to 5% of their peak value. If they sold at all. Most contracts were simply abandoned. The sellers held worthless paper. The buyers refused to pay. And suddenly, everyone realized the same thing at once. They'd been trading promises about flowers. And promises aren't worth anything when nobody believes them anymore. The destruction was real. Court records from 1637 through 1639 are filled with tulip disputes. Buyers who refused to honor contracts. Sellers demanding payment for bulbs worth a fraction of the agreed price. Fortunes lost. Reputations destroyed. Historian and Goldgar spent years in Dutch archives documenting the aftermath. She found 37 people who paid more than 300 guilders for a bulb. Not thousands. 37. But those 37 were ruined. And the ripple effects spread far wider. Because the Dutch economy ran on credit and trust. Merchants extended loans based on handshakes. Contracts were enforced by reputation, not courts. When thousands of tulip contracts went unpaid, the entire system of commercial trust fractured. The government tried to intervene. On February 24, 1637, tulip traders met in Amsterdam and proposed that all contracts signed before November 30, 1636, remain binding. Everything after that date could be voided for a fee of 3.5% of the contract price. It was a bailout, an attempt to limit the damage by letting speculators walk away for pennies on the guilder. But even that failed. Most contracts were never honored. Buyers simply refused to show up. And sellers, holding bulbs worth nothing, had no recourse. Here's the part that makes Tulip Mania matter today. The narrative you've heard, the one popularized by Charles Mackay in his 1841 book Extraordinary Popular Delusions and the Madness of Crowds, claims the bubble destroyed the Dutch economy. That people drowned themselves in canals. That the entire nation was plunged into ruin. Modern historians say that's exaggerated. The Dutch economy recovered. Trade continued. The Golden Age didn't end in 1637. So some scholars dismiss Tulip Mania as overblown. A minor event inflated by moralists and storytellers. But that misses the point. The economic damage wasn't in GDP collapse. It was in the collapse of trust. Dutch society in the 1630s operated on a foundation of commercial honor. Your word was your bond. Contracts were sacred. When the tulip market imploded and thousands of contracts were voided, that foundation cracked. People who'd built their reputations over decades lost them overnight. Families who'd honored every debt suddenly defaulted. And future transactions became harder, riskier, more expensive, because lenders no longer trusted borrowers the way they had before tulips. And the real lesson that echoes across for centuries, is this. Financial bubbles don't need to destroy economies to destroy lives. Tulip Mania didn't crash the Dutch stock market. It didn't bankrupt the government. But it ruined individuals. The weaver who mortgaged his house and sold his loom to buy tulip contracts lost everything. The merchant who borrowed heavily to speculate ended up in debt for decades. The reputation damage alone was catastrophic in a society where trust was currency. And it revealed something permanent about human psychology and markets. When prices rise, people assume they'll keep rising. They borrow to buy. They buy to sell. They sell to profit. And the cycle feeds itself until the moment it doesn't. Until one auction fails. One buyer refuses. One contract isn't honored. And the entire structure, built on nothing but collective belief, disintegrates in days. The parallels to modern bubbles are exact. .com stocks in 2000, housing in 2008, cryptocurrency in 2021. Different assets, same psychology. Prices detach from fundamentals. Speculation replaces investment. Leverage amplifies gains. And when confidence breaks, the collapse is instant and merciless. The only difference is scale. Tulip Mania involved a few thousand speculators in a single country. Modern bubbles involve billions of people globally. The mechanics haven't changed, just the size of the wreckage. Tulips still trade today. Holland remains the world's largest exporter of tulip bulbs, but they're commodities, agricultural products, not assets. The Semper Augustus, the crown jewel of 1637, no longer exists. The virus that created its unique coloring weakened the bulbs over generations until the variety died out. The most expensive tulip in history is extinct. A fitting metaphor for the bubble itself. Beautiful, fragile, and ultimately worthless. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.